So today, I'm Lori McLaughlin, the Chief Marketing Officer at Digital Onboarding, and your hosts for today are Bruce Paul, who's the Managing Director of the Banking Division at Rivel Research, and Tricia Hrotko, who is our VP of Strategic Growth at Digital Onboarding. Today, we're going to talk about how engagement and cross-selling can impact your bottom line at your financial institution. We're going to share some satisfaction insights for consumers in the state of Pennsylvania. And we're also going to talk about best practices for cross-selling customers and members. And I think we can begin.
All right. Well, this is Bruce Paul. I'm the Managing Director at Rivel Research. Glad everybody's taking a little bit of time, and greetings to all the subscribers who are on the call. Nice to talk to you. And wanted to introduce myself. I am the founder of the banking benchmarks, the Pennsylvania banking benchmarks, the benchmarks we've been using to track the consumers and prospects across the entire state for the last several years. And I thought before we begin, I'm going to be sharing a lot of your own customer and prospect ratings and rankings across the state, and hopefully a lot from your bank or credit union. But I thought before we jump into the data, if you don't mind, I'll take a couple minutes to explain the data, where it comes from. So those of you who are not yet familiar with the benchmarks have an idea, so we can go forward one slide. And so about the Rivel banking benchmarks, these are the Pennsylvania banking benchmarks that many of you are familiar with. If you're not, it's the world's largest banking study by a long shot. We do hundreds of thousands of interviews and get millions of reviews per year. We're covering not just Pennsylvania, but a bunch of other states. But we've been doing Pennsylvania for several years now. And basically what it is it's a customer experience program across every single institution in Pennsylvania, where we're doing interviews, a huge representative sample across the state, represented by gender, income, ethnicity, et cetera, where we're talking to a representative sample and asking them about the banks they work with and their impressions of and their ratings of their particular bank. But we also do a second benchmark about banks they don't work with. Are you aware of? Would you ever consider switching to other banks? So we've got two different benchmarks that we do. So we're talking to your customers or members, and we're also talking to your potential customers or members about you. And I'll be showing some of the comparative results, things that your customers or members have said about you and how that compares to competition, and also some things that your potential customers have said about you and how that compares. Another couple of notes about this. It's probably important to mention that this is a double-blind study. We do that for accuracy, and what that means is we don't tell people we're interviewing them about the bank before we start to interview them, so that we don't get any bias. Because as you know, if you go out and interview your own members or customers, you get basically a biased sample. Not that anybody's lying, it's just that you get a skewed sample towards the people who are really happy and they want to answer the survey, and the few people who are very unhappy and also want to tell you that, and then not a lot of people in between. But if you do it in an unsponsored way, in a double-blind way, you eliminate that. So that's important to mention that that's how we conduct this. It's a survey that we do twice a year, and we just published the results for subscribers. I'm not sure if anybody has any questions about that, but if you do, please, I think you can go ahead and ask any questions in the chat box. That's the place where we'll see if you have any questions, and we'll try to address those as they come up. So let's jump into some of the background data. First of all, want to share some of the numbers. You may be familiar with these numbers, you may not, that we've seen across the state, across the region. Some very important numbers, obviously, to you. We're going to be talking about customers, making customers happy, and getting new customers today. So thought we would establish a baseline. As you may or may not know, the average cost of acquisition is about $301 across the state. It varies, some places a little bit more expensive, some places it's less expensive, but that's average. So that's the cost it takes to acquire a new customer on average. Now, it's somewhat higher than that if you consider that in the first year, if you get a new customer in the first year, somewhere between 30 and 35% of those customers will leave in the first year. So that's not really an acquisition. So your marketing dollars are pretty precious, but you've got to retain them once you get them in. Also wanted to point out, as we know from our surveys, that the average number of products that a customer has at an institution is 2.1. Some are higher, some are lower, and that includes all institutions. So when we're talking to your customers, we're not just talking to them about you. We're talking to them about who else they use. So let's say they have a checking account, a savings account, and maybe a HELOC with you. Well, you know about that, but you don't know about the other business that they have elsewhere. We're actually talking to them about maybe the car loan they have with a local credit union, or the credit card they have with a national bank, or the mortgage that they have with one of your competitor community banks. But we do know that the average number of products per customer, it's per household, is 2.1 with any other banks. And that does include, you have a lot of monoline customers who may just have one product with you, and you have a lot of customers who have 10 products with you. So that's the average across the state. And then finally, wanted to point out, in case you've never done the calculations of customer lifetime value, basically customer lifetime value is how much money, how much profit does a customer bring you over the lifetime of their business with you. The average right now is 3,853 to be exact. Obviously, there are some customers that are much less profitable. Maybe they're only with you 3 or 4 years and they only have 1 or 2 products. And then you have other customers that are other households that are much more profitable, where they have 5 or 8 products and they're with you for 50 years. The average tenure, by the way, in Pennsylvania is 17 years. So that's the average amount of time that somebody spends with a bank. So obviously you'd like to get that up to 50 years and not down to 17 years, but that's the average profit that you make off of a customer in their lifetime. So given that, you can make some pretty important improvements. So if we move on to some of the things we're going to be focusing on here is how to lower the cost of acquisition. So we know that the cost of acquisition is $301, and that's for your average institution, but you can lower that down to $198 by changing your marketing. And by changing your marketing, I mean focusing on pain points. Let me just step back and define that. As you know, Pennsylvania is not growing. We have some new residents moving in, some people moving in, some people moving out, but there's not a really strong growth market. It's not like Denver or Phoenix, where you have hundreds of thousands of people moving in every year, and you could basically make your living by just banking the new people moving into the area. That's not what's happening in Pennsylvania. In Pennsylvania, in order to grow your share, you have to capture business from competitors. I think we all know that. So what we found that is, if you target the pain points of people at your competitors, the reasons they want to leave your competitors, you're going to be much, much more effective at drawing their business. It's kind of logical, but as you know, most institutions do not do that. They just sort of promote, hey, we're a great community bank, or we're a great credit union, or you should really switch to us. We're really nice people, that sort of thing. And that's fine. That results in the $301 cost of acquisition. But if you focus on what they're unhappy with at their current bank, you're going to be far more likely to attract them to your bank. And so if you do that, you lower your cost of acquisition down to $198. Secondly, in terms of your share of wallet and cross-sell, if you can understand your customers better and understand their product perception and their barriers to getting more products with you, you can increase your products from an average of 2.1 to 2.4. Now, 0.3 products doesn't sound like much, but that's a 15% addition to your bottom line. At no extra delivery cost. So that's quite a huge amount of money. Kind of obvious, but if you can understand your customers more and understand what they want and what they need, then you're going to cross-sell more to them, just because you understand them and you are having conversations with them at the right time. And then finally, just in terms of the increase to the bottom line, as I mentioned on the previous slide, the average customer lifetime value is 3,853. So if you just save 26 customers from leaving, which is a teeny tiny percent of your customer base, you've just put $100,000 straight to the bottom line. So if you, for instance, if you had 26,000 customers and you saved just 1% of them from leaving, you would have added $1 million to your bottom line. So this is pretty important. If you can understand your customers better so that you can cross-sell, and understand your potential customers better so you can attract them, it really makes a big difference. That's just some of the background details that we found from our research. Now, let me dig into and show you some of the detailed responses. So here are the latest results of the benchmarks. These are from earlier this year, pre and sort of during the start of COVID. The overall ratings. What you are now looking at is inside of each of your competitors. So I've got a couple of them. I've got this one's Greater Pittsburgh, and I'll show you Greater Philadelphia in a little bit. So these are the customer ratings of each institution. So you're now looking inside of each of your competitors, and you're also seeing what your own customers or members say about you. Just to point out, for when I mentioned this is Greater Pittsburgh, so that's Allegheny, Washington, and Westmoreland County. So let me quickly do a caveat and say this is the broader Greater Pittsburgh. Now, if your footprint is part of Pittsburgh or overlaps with some of this, but not other parts, or maybe it's a smaller part of Pittsburgh, take this data with a little bit of a grain of salt, because we may be comparing you to people who are maybe a little bit outside your footprint, because we had to go broader into Greater Pittsburgh. So if you would like to see your own individual data, just let me know and we can provide you some of that. But basically, what you're doing is you're seeing exactly how each customer base of each institution rates that institution. So you see up at the top, Washington Financial, their customers are quite happy. Not over 80, but they're quite happy with the institution, and they rate it quite high. Whereas looking down at the bottom, maybe Westview Savings, their own customers are not that happy with the service and the quality that they're getting at the institution. And by the way, I should mention that when we talk about overall quality, there's a lot of different metrics that go into that. When we interview your customers and everybody's customers, we ask up to 53 different metrics, and overall quality is a roll-up of several of them. Looks like we got a comment or a question. Sorry, what is the average for this group? Oh, the average for this particular group is, I think it's about 72, 73. And let me apologize. I know there's a lot more. I think there's maybe 30, 35 institutions on this chart. And I think in the Greater Pittsburgh area, there's something like 80 institutions. So we couldn't fit them all on one chart. So if you aren't showing up on this chart, please go ahead and let us know. We can share with you your results from your own customers. But just in terms of the components that go into overall quality, there's obviously a lot of different components that do. It can be things like how well do you help your customers improve their financial well-being? Do they see good value for fees? How well trained are your staff? Do you treat your customers with respect? Do they feel like their money is safe with you? So there's lots of different components that go into this. So there might be some institutions that do very well at all of those metrics or most of those metrics, and then some maybe down at the bottom that do particularly poorly at one or two of those metrics, and therefore get pretty low scores from their customers. So obviously it's very important to know what your customers think of you, and this is sort of the first layer of that. Don't know if anybody had any questions about that or how we derive this, but if you do, I mean, we can share a little bit more information afterward. Don't want to go into too much detail now. Let's see. Also want to move on. There we go. Here's Philadelphia. So if you weren't in the Pennsylvania, I'm sorry, if you weren't in the Pittsburgh chart, here's the Philly chart. Again, you're now looking inside of each of the institutions, what their own customers or members think of them and the service they're getting. So as you can see down at the bottom, Wells Fargo customers are pretty unhappy with the service they're getting in Philadelphia. Remember, this is very localized results. So for instance, Wells Fargo in this case, pretty poor results in Philly, but they've actually got better results in some other markets. So it's really important, obviously, for you to see how your competitors are competing against you in your particular market. And that certainly is the case here. You've got some institutions like Santander and Key and PNC to some extent that have very different ratings in different parts of the state. So if you're, say, in Harrisburg, if that's your main market, don't take a look at this and say, oh, well, Wells Fargo must be bad. Well, they might be quite good in Harrisburg, and they're just happen to be bad in Philadelphia. And by the way, I should let you know, when we say Greater Philadelphia, this covers Montgomery, Chester, Philadelphia, Bucks, and Delaware counties. And let me reiterate again, if your particular footprint or your trade area is not exactly those 5 counties, let us know and we can share with you the results in your particular area. So please feel free to do that. Again, you're looking inside the institutions, and I wanted to, sorry, go ahead and we will talk now about switching. So when we get some of these presentations, everybody wants to know what's the switching behavior, what's the market potential, and here you go. This is the market potential across the entire state. So let me tell you exactly how to read this chart. So when we're talking to your customers and your competitors' customers and everybody's customers, we're asking them to rate you on many different metrics. And part of that is we get to see how happy they are or how unhappy they are. And so across the entire state, and this is the data from the entire state, you can see on the right-hand side, 42% of all households in Pennsylvania are really happy with their bank. So don't even try to steal those people. They're really committed to their bank, and their bank would have to screw up not just once, but probably multiple times before they became, before they might become a potential customer for you. And then you see down below ambivalent, there's 34% that are, yeah, you know, that they don't necessarily think their bank is the best, but they don't think it's the worst. The important thing for you is the upper left, the vulnerable. That means 24% of households across the state are currently unhappy with their bank. That is a huge percentage. Just think about that. If you all of a sudden put together the marketing campaign that attracted all those people and you won all that business, that would be millions of households that you would get. You would instantly become the biggest bank in Pennsylvania by far, and probably one of the largest ones in the country, if you were able to capture almost 1 out of every 4 households in a big state like Pennsylvania. So there's a huge amount of potential right now within Pennsylvania. Let me just point out, it's important to point out that although these people are unhappy, that doesn't mean that they're all switching. Remember, you can be unhappy and stick with your bank. And there are certainly thousands of people that we interview that are very unhappy with their bank. They think that their bank isn't very good. Maybe it's not responsive. Maybe they think the fees are terrible. Maybe they think the mobile app stinks or whatever, but they're not going to switch. And why? Well, because they're not convinced anybody else would be better. Or they might think, well, switching costs are so high, it's a pain to switch, and I'm not sure if somebody else is going to be better. If they're sure that somebody else is going to make their life better, then they would overcome the switching costs. But basically, a lot of these people are just not hit with the right message at the right time. You know, they see a lot of people saying, hey, we're a great bank, switch to us, switch to us. But if an unhappy household is really unhappy because their particular bank is really unresponsive, then what's going to make them switch is the message that comes from the bank that says, hey, we are super responsive. That's what we're really good at. Then that person's going to switch to that bank. So, so it's 24% of the market share is up for grabs. Doesn't mean they're all going to switch, but they certainly all could switch if you hit them with the right message. And again, this varies by market. Here's an even bigger aha. Look at that, 31%, almost a third of businesses are unhappy. And by the way, this includes small business, middle market, and large corporate. So almost a third of them are so unhappy that they'd like to switch. So there's a huge amount of opportunity. And this is actually pre-PPP, this particular data. Obviously, the PPP, we are in the middle of interviewing right now for our latest wave, and we're seeing about 78% of businesses were pretty pleased with how the PPP went. But that means 22% of them that did go through it are not pleased. And actually, a lot of the folks who actually got the money are still really mad at their bank. So vulnerability is actually going up. Switching kind of slowed down for a little bit because people were pretty hesitant as things got chaotic. But now that things are getting hopefully more back to normal, people don't forget that a month, 2 months ago, they're really upset at their bank. So the number of people who are unhappy has gone way up. And again, if you hit them with the right message, it's not just, hey, you didn't like the PPP at your bank, why don't you switch to us? That's not a reason to switch to you. That's a reason to leave their bank. But if you can hit them with the right message that speaks to the pain points at their previous institution, that's how you're going to gain business from them. Okay. All right, moving on. Wanted to point out that the vulnerability you saw was quite high across the entire state. It does vary quite a bit by area. You saw Philadelphia and Pittsburgh, but Lancaster County, Dauphin County, quite different levels of vulnerability. So one thing you need to keep in mind is you really need to understand your particular market. If you are in one, if you're just in Allentown, maybe everybody in Allentown is happy with their institution, in which case you shouldn't spend anything on marketing. You should circle the wagons and make sure your own customers don't leave. But if you're in, say, downtown Philadelphia and a lot of people are really unhappy, then pour your money into marketing because you're going to get a huge ROI. It's really, really important to understand the vulnerability in your trade area. So if you'd like that, we can do that too. In terms of who is switching, this might be a surprise to some. Millennials are the most likely to switch. Boomers are the least likely to switch. A lot of people just assume that Gen Z is going to be the most volatile, but they're not yet. They're about the same level as Gen X right now. But we will see over time how that changes. And most importantly, why are they changing? And this is really the most important probably piece of this presentation, the early part. Want to talk to you a little bit about why people are switching. So I thought I'd play a little bit of a game. These are the top 10 reasons people switch. Could be bad technology, could be the fees are too high, they're not friendly, the staff is poorly trained, maybe they get the runaround, maybe they get treated like a number. So before moving on, I'd like to ask everybody, can you guess what the top 3 are? And you can throw it in the chat or just think about it yourself, but feel free to throw in the chat. Maybe you can guess the top 1 or 2. I'll give you a little bit of time. What are the main reasons people are switching? Okay. I do a lot of presentations for large groups, sometimes, a few hundred community bankers. And I used to say, hey, I'll give $100 to anybody who can guess 2 of the top 3. Nobody even got 2 of the top 3, but it was close sometimes. And so I stopped doing that. I didn't want to lose my money. Anyway, so here we go. This is the top 3 reasons that people are switching banks right now in Pennsylvania. Go ahead and advance to the next slide. There we go. So the top 3 reasons. The number 1 reason that people are switching banks is because their bank is not proactive. The number 2 is they're getting the runaround. Number 3 is rates. I would ignore rates right now because obviously rates are going crazy. But that might be a surprise to everyone that proactivity and runaround are the top 2 reasons. And when we say proactivity, that just means the bank just doesn't try to help them out and try to suggest new products and solutions. And that's a big surprise for a lot of community banks, because a lot of community banks would guess that pushiness is the most important. Whereas proactivity is kind of the flip side of pushiness. It's actually leaning in and suggesting things to your clients. It's not doing it willy-nilly. It's not like, hey, it's HELOC Tuesday. Anybody who walks into a branch, let's offer them a HELOC. It's thoughtfully thinking about what's the next product? How do I help? And remember, this is coming from customers themselves, switchers themselves, about what they're not happy with. This isn't some consultant, expert in the industry, or anybody else telling you this. This is 150,000 people responding, and we talk to people before switching, during, and after switching. And proactivity, lack of proactivity is the #1 reason. Again, this is statewide and it does vary. So it's different in Philadelphia than Harrisburg. It's different in Allentown than Pittsburgh. So obviously you need to know what the reasons for switching are in your area, and we can provide that if you'd like. But hopefully that's a little bit of a surprise for folks. And then here's the rest of the top 10. So if you thought that the #1 reason that people were leaving was because of technology, it's actually the 1, 2, 3, 4, 5, 6, 7th most important reason. I know it doesn't seem right, because guess what? Technology is one of the top 2 things that people complain about. But remember, if people complain, might mean they're unhappy, but will they switch banks? And the answer is yeah. Some of them, a small percentage, will switch banks because of technology, but there are other much more important reasons people switch banks. Doesn't seem intuitive because you get so many complaints, but that's just one of the things that people complain about. People complain about technology, but don't typically switch because of it. And I know that that's hard to maybe get your head around, because frankly, I feel bad for a lot of community banks and credit unions, because you're always being approached by a new core provider or a new managed service provider that's trying to provide you some more technology. But the technology itself is not causing people to leave. Also, let me just point out, for the friendliness, you see not friendly. That doesn't mean that you shouldn't be friendly, okay? It just means that's not why people are switching, because guess what? Their bank is friendly. So that's not a reason to switch. As a matter of fact, just think about it. Every bank is friendly. Even the biggest banks, at least the people are friendly. That's sort of table stakes. As a matter of fact, when we ask people if their bank is friendly, the average is in the 90s. So even if you have 99% of your customers saying you're very friendly, well, that's kind of table stakes, and it's not much higher than average. So that means that people don't switch because they're not friendly. It's still important to be friendly, and everybody is, but that's not a reason for switching. Hope that makes sense. Let me know if you have any questions about that. Thought we would share a couple of examples of the feedback. So as I mentioned, we cover 53 different metrics of your customers, and we get a lot of feedback about things that they like, things that they don't like. Here's an example about proactivity. I won't read it through. Yeah, but proactivity is leaning in and trying to help your customers. And by the way, we have a lot of customers who rate their bank both pushy and proactive. And as you can guess, if they say that their bank is both pushy and proactive, they're going to be a very loyal customer, because they'll say, yeah, they're trying to sell me products, but they're trying to sell me products that are good for me. So that's great. Here's another example about the runaround. We see a lot of this. That is the definition of runaround, and we see an awful lot of that. Sometimes a bank might think that they solve an issue on the first or second try. They don't realize it's actually the 4th or 5th try from the customer point of view. So runaround is very, very important in some cases. And then finally, wanted to talk about one of the important things about share of wallet. Obviously, that's where the dollars come in. So here is the actual share of wallet of a bunch of the banks. And I apologize if you, I know we have a lot of people on the call, so if your bank or credit union isn't on here, let us know and we can share you what some of that information is. But basically, this is a comparison of who's doing a good job in cross-selling to their customers and who's not. Or actually, I would put this, who's doing an okay job and who's not. Look, nobody is at 100%. There isn't anybody on this chart that's even at 90%. And I know that nobody on this call, obviously you don't know the share of wallet that you have. You only know how many products your customers have with you. You have no idea if that's all the products or half the products. Are they being unfaithful to you and also have products at another institution or not? So that's one of the things that we track over time. It can tell you exactly where you are and how far you have to improve and how you do that. So, just thought this would be a good, hopefully an eye opener for some to show how you're doing against your competition and how much more you have to go to try to get 100% of your customer share of wallet. And thought maybe I'd stop there and then hand it over to Tricia. But if there's any questions about the data, or if you'd like some more detail, let me know.
Bruce, we do have a couple questions that I wanted to ask from the first one is, how do you contact an institution's customers to do your research?
Oh, okay. Yeah, so what we do is we do a giant sample, a representative sample, where we don't go through any institution. We don't ask you for your customer list. We actually go to a huge representative sample of tens of thousands of people across the state and do that through representative panels in order to recruit them and recruit an exactly representative sample of the entire state. So again, we aren't asking anybody for their customer list. That would be a biased sample. We wouldn't want to do that. That would affect the accuracy of our data. So we just go directly to households and businesses and talk to a representative sample. So it ends up being, if, let's say we do 20,000 interviews and you happen to have 2% market share, then we will have talked to, 400 of your customers. So we end up with the exactly represented the exact same household market share that exists in the market. I hope that answers the question. Yeah.
And then just one more question before we move to the next section, which is, when do the new benchmarks come out?
Oh, yes, good question. Sorry, and I didn't address this before. So the benchmarks come out twice a year. They come out in January, and then the next ones come out in August, so it'll be out in about a month. So, and the ones that we're doing right now cover a lot of COVID. We're asking your customers how well they think you've handled COVID, whether they're going to switch to another bank because of COVID, or whether they're going to bring more business to you because of COVID, and why, and what can you do to increase their share of wallet with you. So those results will be out in just a few weeks. We're in the middle of, I think we've done 20,000 interviews or something like that. So we've got a bunch more, maybe 60, 70,000 more to go. So those will be out in a few weeks.
Terrific. This is Tricia, everyone. Bruce, thank you so much for sharing that information. I found it quite interesting, being a former banker myself. And what I, sort of is really eye-opening, and why I'm so glad we partnered today, is that this data is coming actually from the institution's customers or members. So, it's sort of eye-opening, certainly insightful. So thank you for sharing that. So now we're sort of moving on to part 2 of the presentation, now that we have some great data to work with. And in particular, this slide right here is a great jumping off point, talking about cross-selling. If we don't have the share of wallet of our customer member base that we would like to see, how can we make that better? And obviously, cross-selling or cross-servicing, depending on how you call it or what you call it, is very important to an institution. It's important from a number of different perspectives. It shows that customer member that you care about them. They are interested in helping improve their financial life. It also generates more loyal customers who stay with you longer, and then ultimately are more profitable for the institution as well. So going to move on and talk about what I consider the 5 keys to cross-selling success. But before we dive into this, I just wanted to sort of share with you my thoughts on what is cross-selling or cross-servicing. And for me, that means that you're delivering the right message or offer to the right person at the right time. That is really what cross-selling is identifying a need, figuring out the best way to solve for that need, and then communicating that to that particular individual or business. However, we as an industry haven't done such a great job at that. I've been in banking for 18 plus years, and when I started out, it wasn't sort of having these personalized conversations. Marketing geared its product promotion around a calendar, right? So in springtime, it was home equity, and college savings plans were kicked off in July, and we had this whole calendar of things that we wanted to communicate to our customers. And not to say that that wasn't successful, but what you were doing is putting offers and messages in front of someone who it was completely irrelevant to them. We now are in the future, and we have the capability and should be really having very personalized conversations. So that's sort of the backbone of what I'm going to talk about today. Here are my sort of top 5 things that a cross-selling campaign should contain. Number 1, you want to be talking with people who are happy, as Bruce says, with your institution, because those are the people who are far more likely to take that piece of advice that you're providing to them, or suggesting a service or even a product, and act on it. The second is, of course, we need to know what that need is. Telling someone all about, and I literally got an email from an institution telling me about how to establish a checking account for my teenager. Well, at one point I had teenagers, but I don't anymore. So it was like, so why are they sending this to me? I certainly don't have that need. So we want to understand someone's need. We want to make sure we get the timing right. This is a little bit trickier than understanding the need, but getting the timing right just makes whatever that campaign is much more successful. If you're hitting that person at the exact right moment, you have much greater chance of success. I'm going to talk about personalization, and really personalization is not just using somebody's first name. And I'm going to dive into really what that means. And lastly, and this seems like an easy one, if you're providing an offer or suggesting a service, make it super simple for that customer to take action. I sign up for bank newsletters across the country. I have accounts at lots of different institutions. And sometimes it just really amazes me that someone thinks it's okay to have like 4 clicks before I actually get to where I need to take an action. Every single one of those clicks is an obstacle to someone actually taking advantage of whatever it is that you're putting in front of them. So we're going to dive a little bit more into each of these items, and I have a couple of examples of what we feel are sort of really good ways to incorporate these as we go along. Feel free, of course, to lob in any questions through the chat. We'll have some time at the end to answer any additional questions, either for Bruce or myself. So fully engaged, I mentioned, talking to fully engaged customers generates much better results. So what do we mean by fully engaged? Well, Javelin did a study, and for any of you on the line who I've talked to about onboarding, you've seen this before, but Javelin did a study a couple of years ago, and I'm confident that what they found is still true today. And that simply means is someone who's fully engaged with your institution thinks of you as their primary financial institution. So they're far more likely to deepen the relationship, and ultimately they're far more profitable for your company. So Javelin does, their definition of fully engaged is they, had to have a checking account and do 3 things at least within a 60-day period of time, which makes perfect sense. Money needs to come into the account through some sort of deposit, likely a direct deposit, and usage of the account. They're using their debit card to make purchases, get cash, what have you, and paying bills, whether it's through your platform or using a third-party biller. So if they're doing all those things, they're considered fully engaged. And like I said, that translates to they're 4 times more likely to deepen the relationship. So this is the group that you should be really trying to figure out what are their additional needs, and talking to them on a regular basis. That translates to $212 in incremental profit per year per relationship. So, obviously it makes sense to talk to these people because they're the ones who want to continue a relationship with you. Now, the other thing that's not on this slide is that study also said, ask the participants, well, what does your checking account portfolio look like right now? How many people are actually fully engaged at your institution? And the average was 45%, which means less than 50% of your checking account holders are fully engaged with your institution, which leaves an awful lot of people who aren't. Now, that's not to say that you can't engage, try to continue to engage them, but your pool of, truly successful cross-selling is much smaller. And the way to solve for this is to make sure that you're engaging with these customers the moment they join your institution. Because if you do that and you get them into that, what I call fully engaged bucket, the next thing that you're going to want to do is solve for additional needs, and you'll be that much more successful. So I mentioned identifying specific needs, right? We want to do this intelligently. We want to put the right offer or the right message or the right suggestion in front of the right person who has that need. We don't want to be doing, sort of the mass market, let's throw a home equity rate out there and send it to everybody. Well, if I'm a renter that, has absolutely no bearing on my life, I'm not going to be taking out a home equity loan. So let's make sure we take a step back, understand that customer, and put an offer that makes sense for them in front of them. And, I know that's can be very challenging. We have, as institutions, quite a bit of data on our customers, but not everything. But there are, third-party providers to help you build a better understanding of who your customers are, and certainly could help identify gaps and needs. So as promised, here's an example that an institution went out and purchased data from Equifax, and what they had sought to do was find out, this happens to be a credit union, find out how many of their members are applying for mortgages elsewhere, so not with Alliance. They were able to get that data from Equifax. It had quite a bit of information in that file. And then what they immediately did was put in front of them a very highly personalized communication that said, hey, we know you've applied for a mortgage somewhere else. Did you know that you could get that same mortgage at a better rate with Alliance? You already know who we are. If you'd like to do that, click here and we'll expedite your loan application. And by the way, you're pre-approved and this is what your rate is going to be. Fantastic success with this program. Within 45 days, they booked over $1 million in new loans. And in terms of ROI, all costs included, use of our platform and the Equifax data, for every dollar they spent, they returned $18 in gross profit. So super successful for them. And again, it's just understanding that customer need and getting that offer in at the exact moment that customer member needs to be hearing from you. Being proactive, right? So Bruce just talked about this, that one of the #1 reasons people want to leave their institution is they feel like their bank or credit union never communicates with them. They don't seem to care whether or not they have any additional needs, or seem to care about their, what's going on in their financial lives, and they would like to have a partner, in their financial institution. So I mentioned timing. Now, the timing part of getting a cross-sell offer in front of either an offer, or like I said, that could be a suggestion for financial wellness. It doesn't have to be a necessarily product offer. Getting it in front of your customer member at the exact right time, that's not easy either. But there's data out there, there's information that can help us do that. And of course, we just had an event, unfortunately still in it, a pandemic, right? So people were craving information from their financial institution because everybody's worlds turned upside down seemingly overnight. But it was remarkable to me that, my primary financial institution, remarkably, I did not receive a single email from that institution, at least for, I think, the first 6 weeks. At a time where, customers and members really needed to hear from their financial institution, it was sort of shocking to me. So, that's a sort of obvious way to understand timing. And the example I'm showing you is an institution who understood that, they suddenly had to close their branches. So like many other institutions, they promoted their mobile banking app and the ability to, if somebody had a paper check, how to get that check deposited using the app, which is fantastic. But what this institution did really took it a deeper step. They made the communication extremely personalized. They didn't send it to people who had already enrolled in the mobile app, right? So they did an intelligent targeting. And then they got really specific in the communication on, first of all, how to download the app, what the customer is going to need it to do to get that done. And by the way, if you do have a paper check, here's instructions on how to get that done. And that actually was missing from a lot of the early communication that I had seen. So it's not only timing, but understanding, making that communication as helpful as possible. They happen to see, I think it was 5,500 downloads of their mobile app within a 24-hour period of time. So fantastic response. And they heard back from a lot of their members that it was, very, very helpful that they were being proactive and getting this information to them so they didn't have to sort of call the call center or hunt around on the website to figure out how to get it done. Okay, just having a little bit of fun here. Guess which one of these is my least favorite salutation? and seriously, these are emails that I received within the past week. I won't tell you who sent me "Hello Shoe Lover." I'll let you all guess who that might have been, but of course, least favorite salutation was "Dear Valued Customer." In this day and age, sending out a piece of communication that's not personalized, at least with your customer members' first name, is just, that's table stakes. But when we talk about digitizing communications, and certainly, not to harp again on COVID-19, but, the ability for us to have in-person conversations with our customers and members obviously has been significantly impacted. And there are some people who think that is going to be our new normal going forward, that people are not going to come back to our branch locations in droves, and that if you hadn't thought about having continuous conversations with your customers and members digitally, you had better start thinking about it now. And that also means mimicking a conversation. So "Dear Valued Customer" is not something that would come out of a branch person's mouth. So it shouldn't be in your communication to your customer members either. And again, this kind of goes back to getting data, understanding who your customer is, but every piece of information about your customer can be incorporated in digital communications pretty easily to again, communicate to that member or customer that who they are, down to the name of the product they have, or what branch they branch at or bank at, or what town they live in. You have a lot of data. It can be personalized, so it mimics more of a one-to-one conversation than a generic communication. And that's our goal when we're talking about having conversations. The example I'm going to show you is one where, again, it was specific to a credit product, but the institution had gotten information on customers that had auto loans at competitive institutions. So they combed through the data, found some of their customers who would benefit by refinancing their auto loan, broke it down into even determining how much they could save And in that data was the make and model of the car that that person had purchased. So what they did was sort of bake that right into the communication. So just coincidentally, we have the generic example here. It says, "Hi, Tricia." So sorry about that. But it says, "Hey, Tricia, what's better than driving around town in your Mini Cooper? How about saving, $487 a year on your auto loan?" So that feels to that customer extremely personalized. You know who they are. You're providing a benefit to them, and of course, doesn't start out as "Dear valued customer." And lastly, I mentioned this: make it easy for someone to take advantage of whatever offer that you're presenting. Don't make them go to a generic page on your website. Certainly don't tell them that, you're sending them a text or an email saying, well, in order to do this, you need to come into a branch, right? So we want to make that step to have them take advantage of, opening another product or getting more information on, how to apply for a PPP loan, or, whatever the communication is, put it right in front of them. And if there's any action, just make sure it's simple and seamless. Throwing up those roadblocks is going to impact the level of response and success that you have. The example we have here, this particular institution, in the fall, which I guess is a popular time to offer credit cards, identified a target, put a campaign into market that was heavily focused on direct mail. And I've been doing this for quite some time. And of course, when you get a piece of paper, you can't click on that to submit an application, right? You've got to stop what you're doing. If you think it's a good offer, make sure you flip on your computer, or, try to find the bank and then search around the bank website to figure out where this offer is that you just got in direct mail. Just not a very efficient way of doing this. They replicated the same campaign, but created a highly personalized email. Talked about a pre-qualification, the benefits of their particular credit card versus others, and a one click to a very short application to accept the offer. And simply moving from sort of passive direct mail to highly personalized email doubled their conversion rate. So again, being very mindful of what actually is that call to action. Is it an easy thing to do? And if it's not, you got to rethink how you might want to put that communication forward. So with that, we are just almost out of time. I hope you certainly enjoyed our presentation today. And at this point, we're happy to take a couple of questions. If you haven't already done so, please feel free to put that in the chat. And also, if you have any interest in, Bruce has had offered many times, if you want to get more granular with the data specific to your institution, you could just lob that into the chat, and Bruce will take you up on it. And similarly, if you'd like to know a little bit more about the digital onboarding platform, again, just put your information in the chat, or feel free to email either Bruce or I. Our information is up on the screen.
Great. We have gotten some questions, so I'm just going to fire them off in our remaining minutes. The first one is for you, Tricia. Do you think emails are still being read, or is text more effective?
That's a great question. Yes, I still think emails are being read, but as long as they're highly personalized. It's super simple to put somebody's name in the subject line. That tends to get a much higher open rate. It feels like, well, whoever this is that's emailing me knows who I am, so I should probably open it. And yes, emails certainly are getting read, but I will say that text messages are getting read at a far higher rate. I think the last survey said that like 98% of all text messages are open and read. It just creates a tremendous amount of immediacy. Obviously, you've got to do it right. You don't want to be texting people every 5 minutes, but if it's helpful and informative communication, you know, it's absolutely, I think, a necessary part of your marketing outreach.
Great. I've got a question for Bruce. Bruce, how do you help a bank or credit union understand where their gaps are?
How to help them understand what their gaps are? Well, on the customer experience side, basically we talk to their customers and we get evaluations on 53 different metrics. So like when we put together a report for a credit union or a community bank, we basically take a look at what their scores are, and importantly, we compare that to the norm. So like, for instance, if we talk to your customers and 62% say you're very responsive, well, is that good or bad? If everybody else is at 72%, then you have some catching up to do. If everybody else is at 52%, then you actually have a competitive advantage. So every evaluation that we have on for a credit union or community bank, we have the local norms, and it's important that it's very important. It's the local norms. It's not comparing you against every other credit union across the country, because frankly, you don't care how you compare to some credit union your size in Idaho. It's how do you compare to the people in the market, because that's who you're actually competing against for business. So how do your scores compare to the big bank across the street, the credit union down the block, and the community bank around the corner?
Fantastic.
Yeah, and I'm going to jump in, you know, sort of from a targeting perspective. You know, how do you identify needs? You know, there's lots of different ways to do that. You know, plenty of programs have the ability to sort of take a look at customer data and suggest next best product. I've also seen extremely successful surveys that are done, you know, at an appropriate time, asking customers, hey, you know, how likely are you going to need a car loan, a mortgage loan, you know, a savings account for perhaps a 401k account, whatever it is, in the next 3, 6, 9, 12 months. And people actually will answer those questions because they're like, oh yeah, you know what? I am going to need that probably. We've been talking about getting a new car, probably not for another 6 months, but yeah, you know what? You know, tell me what you got. And, you know, so then you can time again, you know, having that conversation at the appropriate time. But there's a couple of different ways you could solve for that.
Fantastic. So we're back at the top of the hour. And so with that, I'm just going to remind everyone to please feel free to connect with Bruce and Tricia directly. We're going to be emailing you a copy of this presentation and the recording. And we thank you very much for joining us today.
Thank you.
Thanks, everybody.